Here is something that has been true across virtually every major war in modern history. Governments almost never tell you the full cost up front, and they almost never ask you to pay for it directly. No politician has ever won an election by walking up to a microphone and saying, "We are going to war, here's the bill, and here's the tax increase that will cover it." It does not happen. What happens instead is something far more sophisticated, something most people experience but almost nobody understands. The cost of war gets moved. It gets hidden inside your grocery bill. It gets buried inside the declining purchasing power of your paycheck. It gets deferred onto your children through debt that will take decades to unwind. Governments have developed, over hundreds of years, a set of financial mechanisms so effective at transferring the cost of conflict to ordinary people without ever calling it a tax, that most citizens never connect what they pay at the checkout line to a decision made in a war room. Here's the core question. If wars cost trillions and governments are not raising taxes, where does the money actually come from? Because it has to come from somewhere. There is no free lunch in economics. Resources used in war, the steel, the fuel, the labor, all have real costs. The question is never whether it gets paid. The question is who pays it, when they pay it, and whether they ever realize they are paying it. The answer runs through three mechanisms: debt, money creation, and inflation. Understanding all three is the key to understanding modern war finance. To understand why these exist, we need to start with a very simple political reality. Taxes are unpopular. This was true in ancient Rome. It was true in medieval England. It is true today. In a democracy, politicians who raise taxes face voters, and voters anxious about a war are not in a mood to also absorb a tax increase. So governments have a structural incentive to find alternative ways to pay for conflict, something that does not show up on a tax bill. The first modern attempt to solve this at scale was the American Civil War. In 1861, the federal government was broke and at war. It printed greenbacks, paper currency backed by nothing but a promise. It sold war bonds, IOUs to citizens willing to lend their savings. By 1865, the national debt had exploded from $65 million to nearly $2.7 billion, a 40-fold increase in 4 years. Both mechanisms had done their job. The war was financed. But the cost had been distributed in ways people felt without being able to name. Here is the first twist. When World War I arrived, governments had learned from the Civil War and from every European conflict between 1815 and 1914. They had gotten dramatically better at borrowing, and they had developed a new tool for making that borrowing feel like patriotism. The Liberty Bond campaign of 1917 and 1918 was one of the most successful financial marketing operations in American history. 4 separate Liberty loan drives raised over $21 billion from ordinary Americans. Movie stars stood on stage and sold bonds. Schools ran contests for which students could raise the most. Newspapers published the names of patriotic bond buyers alongside those who had not yet done their duty. Buying a war bond was framed not as a financial transaction, but as a declaration of loyalty. You were not lending your government money, you were investing in victory. In reality, you were doing both. The government understood something important about this transaction. When citizens buy war bonds with money they would otherwise have spent on consumer goods, the transaction transfers resources without creating inflation. The spending power moves from the private sector to the public sector. No new money is created. It is a clean transfer. And this is why economists consider bond sales to the general public the least economically damaging way to finance a war. But here is the problem with that model. It depends on citizens having enough savings to buy the bonds. And it depends on national unity and shared sacrifice that is difficult to sustain for a long war in a divided political environment. World War II tested the limits of the bond model and revealed how the financial machinery shifts when public borrowing is not enough. The U.S. entered the war in December 1941. Federal spending went from about $10 billion a year to over $93 billion by 1945. The government sold more bonds than ever, $185 billion worth, roughly 2/3 of all war financing. But the remaining third came from elsewhere. It came from the Federal Reserve. It is called debt monetization, and it is arguably the most powerful hidden tool in the history of war finance. When the government needs to borrow, it issues bonds. Normally, these are sold to private investors who lend their existing money for interest. Money changes hands. No new money is created. But when the Federal Reserve buys those bonds, something different happens. The Fed does not use existing money. It creates new money. It credits the government's account with funds that did not exist before. The defense contractor gets paid. The soldier gets their paycheck. The military equipment gets purchased. And there's more money in the economy. In 1942, Congress allowed the Fed to directly purchase Treasury securities. Fed holdings went from $2.5 billion in 1939 to $24.3 billion in 1945. To suppress runaway inflation, the government imposed wartime price controls and rationing. People could not spend freely even if they had the money. The moment those price controls were lifted after the war ended, the suppressed inflation came out all at once. Prices surged. This is the essential mechanism of hidden war cost transfer. The government creates money, and the resulting inflation is a tax. It falls most heavily on those least able to protect themselves, people with fixed incomes and those with savings and cash. The wealthy hold assets whose values rise with inflation. The poor hold cash that loses value. The inflation tax is the most regressive tax. By 1965, the United States was already spending heavily on President Lyndon Johnson's Great Society domestic programs like Medicare and Medicaid. Then Johnson began escalating involvement in Vietnam. Troop levels went from 23,000 military advisors in 1964 to over 500,000 combat troops by 1968. Military spending climbed from $51 billion to $81 billion. Johnson refused to choose between the guns and the butter. He told his advisors the country could afford both. He deliberately underreported costs to Congress to protect his domestic agenda. He did not ask for a significant tax increase until 1967, by which point the inflationary pressure was already building inside the economy. In 1964, U.S. inflation was running at about 1% annually. By 1966, it had ticked up to 2.4%. By 1968, it was 4.6%. By 1969, 5.8%. Johnson had injected enormous government spending into an economy at full employment. This meant there was essentially no slack left to absorb it without prices rising. The Federal Reserve was in an impossible position. In December 1965, Johnson confronted Chairman William McChesney Martin at his Texas ranch and demanded the Fed not raise interest rates. He reportedly said, "My boys are dying in Vietnam, and you won't print the money I need." Martin held the line that day. But the pressure to accommodate the government's spending continued. The central bank repeatedly miscalculated. By 1968, Johnson was finally forced to request a temporary 6% income tax surcharge from Congress. The political fight was brutal. Conservatives refused unless it was paired with spending cuts. Liberals refused because they wanted to force Johnson out of Vietnam. The surcharge finally passed in August 1968, 2 years after the inflation had already begun, and more than a year after Johnson first requested it. By that point, inflation had embedded itself so deeply into wage negotiations and price setting that the tax surcharge alone could not contain it. The story did not end in 1968. It barely began there. By 1971, the dollar was under such pressure from foreign governments demanding gold. President Nixon closed the gold window entirely, ending the Bretton Woods system and severing the dollar's last formal link to gold. The CPI rose 176% between 1965 and 1980. The cost of the Vietnam War had been paid, not in taxes, but in eroded purchasing power. Here is the secret that ties the history together. The mechanism governments use to pay for war without raising taxes is not a bug. It is a feature. It is a deliberate political calculation about the distribution of pain. A tax increase is visible, immediate, and attributable. But inflation is diffuse. It builds gradually. Its relationship to the original spending decision is separated by time and layers of complexity. No politician has ever said, "The war we started 4 years ago is why your grocery bill went up." That connection is never made explicit. The post-9/11 wars made this mechanism transparent. The Bush administration cut taxes while starting wars, financing them entirely through borrowing. This added trillions to the national debt. The Fed eventually purchased enormous quantities of that debt through quantitative easing after 2008. And the inflation that followed, peaking above 9% in June 2022, was the payment arriving, deferred, diffuse, and not labeled as a war cost. PMC research in 2022 confirmed this pattern across World War I, World War II, and the COVID-19 war. Governments preferred debt and money issuance. The Korean War was the only exception. President Truman insisted on financing it entirely through taxation and maintained a balanced budget. U.S. inflation stayed controlled. It was one of the least inflationary wars since 1865 because the government asked the public to pay directly. Here is the second twist, and it is the one that connects all of this directly to the present moment. The money to pay for war always exists somewhere in the economy. The only question every government faces is whether to take it honestly through taxation or take it slowly through the mechanisms we have described today. History shows they almost always choose the slow path. And history also shows that the slow path is never actually cheaper. It is just less visible until it is not. If you found this video valuable, subscribe and turn on notification. And if this broke down something you had always felt, hit the like button. It is the most useful thing you can do to help this channel reach more people. Click the next video for another insightful analysis. Thanks for watching.